would argue in 2010, because Angela Merkel's comment was in the front page of The Economist, the front page of the Wall Street Journal, it's a huge, huge fact, you would have to take it into account. And you would have to put it into your model. And because there is not a number, it's just a statement, it's unobservable. Observable means a number, not a word. We can observe what she said, but we can't put a number to it. Therefore, it's unobservable. Your point there about how you manipulated the liquidity spread, if it's just the banks got together and it's not market consensus, see, the emphasis of level 2 and 3 is, can the input be checked? Not, is it a good input or a bad input? So if the input could be checked, and it's verifiable to the market, and if all the banks get together, and it's a market input, it doesn't mean it's a good input. So it means I, as an outsider, I could verify it. So just because, so the point I want to make, just because it's level 2 doesn't mean good, and level 3 doesn't mean bad. All right? Level 2 means input verifiable. Level 3 means input not verifiable. Let me just switch over to the other concept. If we talk about IS 39, IS 40, IS 16, there's a concept of reliability. Okay? So does level 3 mean not reliable? You're the examiner, right? Does level 3 mean not reliable? Does level 2 mean reliable? Level 2.
Level 2 is reliable. Even level 3 is reliable.
So is level 2 more reliable than level 3? Yes? He said yes. He's an examiner. Is level 2 more reliable than level 3? Does reliability and the level correlate? But don't change my question. My question is, does reliability and the level correlate?
It should.
Why?
Because if you cannot verify the input.
Okay, so inputs, what is more important, the inputs, the model, the outputs? What's the most important, probably? I would say the model is very important as well, right? Good inputs, crap model equals crap output, right? So, I want to just, because this kind of goes together, and I don't want to spend too much time on IFRS 13, but if we just flip forward ahead a little bit, the concept of reliability, it's at the end of this section of IFRS 13. So, you will see the concept of reliability in IS 39, right? What does it say in IS 39? You cannot use fair value. If it's not reliable, you use cost. Remember that? And one of the biggest headaches is when you move to IFRS 9, you must get the value, period. There is no concept of reliability. So the concept of reliability still exists in 16 and 40, right? So, basically, reliability is saying if the variability of the measurements is not so big. A better way to look at it, it doesn't matter about the inputs. So if I was giving you a loan and you tell me your salary and I go to Moody's, Moody has a program called Moody Analytics. What do you guys use here in Pakistan? Do you use that program?
We do have these scorecards, and it depends on the organization.
Okay, some banks use Moody Analytics. It's very common in the Middle East. What do you guys use?
We do have scorecards and the risk rating models.
Do you use a third-party vendor?
We do use third-party vendors that include Moody's and JCR Risk, but we have such own developed programs, internally developed.
So what you generally will find is if you use Moody Analytics, it's expensive. That's why you don't use it, right? You guys are cost conscious, right? They're not. They're capable. They have all the money, right? So Moody Analytics costs a lot of money. It's a multi-million-dollar program. And what you tend to find is because the program is so well developed on such a large database, if I take your salary or if I take a private company, I put in your details, it asks lots of questions about management. I mean, I haven't used it, I always see the output, but it asks you loads of questions and it gives you a credit rating. Because that model is so developed, you would probably say that is more reliable, right? If you want to save some money and you do it yourself, and you do a model in Excel, and you do it at night, and you're a little bit tired, right? That model is probably not as reliable. So the reliability is based on how robust the model is. The reliability has nothing to do with levels 2 or 3. Obviously, level 1 is reliable by default, right? Level 1 is saying that is the price, no questions. And if you can't say that, it's not level 1. Level 2 and level 3 is saying the input and reliability is based on the model. See the difference there? Is that clear? So you learned something new, right? So just a couple more things. I don't want to spend too much time on this. So level 1, level 2, level 3, that's clear? Okay. So the methodology, obviously, in IFRS 13 is we get the unit of account is what we're valuing, and that's defined in the various standards. So for example, in IFRS 3, you value the entire controlling interest. In IFRS 9, you value one share. So in IAS 16, you value each item that would be in your fixed asset register. So whatever you're going to value is determined by the relevant accounting standard. Then you get the valuation premise is you want to identify the optimal group to value them. So you want to look at how the market would do it. The basis of valuation and the techniques. I'll just go through these a little bit quickly. So unit of account is clear, right? It's by the standard. So with financial instruments, it's usually an individual share. It's not usually a portfolio. There are some exceptions there on some of the more complex products, but generally it's an individual share. The valuation premise is saying you want to value the asset as to how it's used, or how the market would buy it. For example, you wouldn't sell one share by itself. You would probably sell a group of shares in a table. So if this was a unit of account, the valuation premise might be this group of assets, then work backwards to a share. So that's how we're going to deal with that. We have this concept for non-financial assets of the concept of highest and best use. The concept of highest and best use does not exist for financial assets, for non-financial. And there's 3 attributes there: physical, legally, and financially viable. All 3 of those. With that in mind, just look at the second question there in IFRS. Look at the third question, sorry. Question 3. Question 3. Question 3. And what I'm asking you here to tell me is the highest and best use as residential or as factory land. So residential or factory? You want to hide in the back, huh? I'm kidding. Okay, no, I'm just kidding. Can you turn the AC, make it colder? Make the AC colder? So, what's your answer? Factory or or residential?
No answer yet.
No answer yet? Do you have an answer? This is a good exam question, right?
Yes. In fact, we recently examined a situation where we had an investment property and it was already valued on a commercial basis, and we were arguing with the auditors that we should reduce the value which is based on residential. And it was asked on examination for, I think, 3 or 4 marks.
I'm looking forward to seeing your exams. You're easier than me, though, I think.
Huh?
You're easier than me.
Let's see.
Do you have an answer? Do you have an answer? What's your answer? What? Residential.
No, I said commercial. Factory.
She says residential. You say she's wrong?
My calculation says it's
What's your answer?
Residential.
Residential? No answer. You're slow?
residential.
And your answer? Before you become a partner, what's your answer?
Residential.
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 Okay. Residential? He's a partner almost. You know, partners are always right, right? Why?
Because it is not practical to relocate the system.
Okay. So, in IFRS, we have a concept of highest and best use. It doesn't matter how the land is used right now. So if you're going to buy the company and the land is going to be used as a factory, that is irrelevant. What is relevant is the highest and best use. What is the highest and best use? Why?
Because it does the most for you, and
Does it?
management has the plans, or the city government has.
So if she was your CFO and making your decisions, would you say go or would you say stay? She says make it residential, right? No. So you say so if we go by your perspective and we make it residential, what's going to happen? So if we listen to you, we would say, okay, as residential land, how much is it worth?
25 million.
Wait a minute. Hold on. 25 million means the developer gets no profit. Is it fair for the value of land to include the profit from developing?
The beverage company won't be developing it.
But when you look at the price of the land, you can't include in the price of land the profit from actually developing it, right? The construction company must make some money. Correct? So a common technique to value land is the residual land value. Once you take the selling price, the cost of construction, but you also must take out the developer's profit. Because I'm not going to develop the land if I don't make a developer profit, right? So if you take out the developer's profit, the land is worth 17. So if we go by what you're saying, we'll have land of 17, right? Correct? Now hold on. The factory, we have to knock it down, right? So the factory is going to cost us how much to knock it down? 2 million, right? So if I go by your logic, it's worth 15 million, right? and the factory is worth 0, correct? And there's a rezoning fee.